Hello friends, many of the senior executives who are earning say 5 crores, 8 crores a year actually approach their retirement with a totally wrong perspective. What does this mean? It is only in the last decade of their corporate careers that they make the most income. Yes, the 60% of their earnings. However, when they are nearing the retirement, they don't have any plan of action to approach it. The result is 50% impact on their retirement portfolio over the years. Huge drawdowns, huge expenses, just because they went into retirement without a plan. So today I will be showing you a framework for the wealth preservation as well as efficient retirement planning for senior executives and how to plan for it strategically. Okay, in today's video, what we are looking at is senior executives, and we are looking at planning last 5 years of corporate career. Now this is structured for CXOs, senior management, business owners, Indian residents, NRIs, and those NRIs who are actually returning back to India. So therefore, the main paradox we are actually looking at is there is a corporate rigor, but there is a personal passivity. So what does this mean? This means that while you are best in your job, you are the same leader who meticulously planned for $1 billion corporate strategies. But when you approach your own personal wealth transition, there are just vague intentions. So there is no deliberate way, method, and action to actually work on your own wealth corpus, while that is the purpose for which you are actually working or doing job. Apart from, yes, personal gratifications, ambitions, and all those things come into picture, you are working, pursuing your ambitions for remunerations, and that remunerated amount is used to create wealth. But you are passive in terms of your approach to managing your wealth. So therefore, what we're talking about, the 5 years which are actually preceding your retirement is the most consequential period in senior executives' financial journey. Yet paradoxically, yes, there is a passivity there. Now what if we work on the numbers? It is a 60 to 80% of the lifetime wealth is typically accumulated in the final decade of corporate career. It could be through stock options, it could be through deferred compensation, it could be also due to the higher income in the peak earning years. Now, when we are looking at 40% of the executives, yes, 40% of the executives, they enter retirement without structured drawdown strategy. Now, they therefore risk suboptimal outcomes in spite of having the very good bigger base. Now the question is whether you are into these 40% of the executives who are going unplanned, or you are among the 60% performers. Now we have to analyze the tangible cost for the passive transition. The cost is not for the action you do, the cost is also for the inaction. Therefore, the executives who drift into retirement without a strategic plan will face predictable wealth erosion. Now the cumulative impact of tax inefficiency, there are the healthcare surprises that would come. Investments misalignment would be there. When you look at over the next 5 years, the whole accumulated difference could be 30 to 40% of the retirement corpus. So now let us consider a tale of two executives. Both are retiring at 60 with a 15 crore corpus. Now what are the definitions? If you look at the tax efficiency, in case of passive transitions, what they will do, if he is having an ESOP, he is looking at an ESOP being taxed at the peak slab, because there are the double type of taxation. Now there's the fair market value of the ESOP, and then there is the exercise price, and you're taxed on that. And when you actually sell it in the market, then there is another level of the tax. So therefore, have you planned for that taxation, how you should calendar your ESOP transactions? But if you go towards strategic runway, we are looking at staggered exercise and LTCG harvesting. When you look at the healthcare coverage, you are actually scrambling over the cover post-retirement. So you are being covered by your corporate, but once you retire, then you have to see, okay, which is the best plan for that. Whereas a person who is going strategically will have a comprehensive policy secured when he's around 55 years of age. So when you're looking at asset allocation, till 70% of the equity at retirement. Much of the money will be actually into the equity corpus at retirement. But in case of the strategic runaway, there will be always a gradual de-risking with only 40% into equity. Now, when we talk about income streams, he relies solely on the corpus drawdown. And while he would be having a much of the real estate portfolio with him amounting to 10 to 15 crores separately, but not much of the income would be generating out of it, because it would be stuck with residential properties which have the low rental yields, or even under constructions, non-completed NCLT properties for that matter. But the other way, the person who is having a strategic framework will be having an income coming through dividends, through rentals, through annuities, and through the consulting. So when you are looking a person who is at 60 years of age, and we are looking at effective corpus at 85, we are looking at 12 to 15% of the corpus which is actually preserved, and here we are looking at 3 to 4 crore of the corpus which is actually depleted. We are looking at actually the two people, both are at 60 years of age. One is going passively, one is going actually in a strategic way. A person who is going passively will be taxed hugely on the ESOP slab, and also he's withdrawing money from his portfolio, and there will be many issues coming with health and other expenses. So he's looking at 15 crore of the corpus being reduced to 3.5 crore. But where there is a strategic structuring, he will see that his 12 crore to 15 crore of the corpus is still preserved while the income is being earned on that and consumed. When you are architecting your runway, what should be the 5-year strategic framework? A structured approach to the retirement involves specific actions. You have to act, you have to take certain actions which are calibrated to each year. So it has to be an year wise. Now it is not about preparing for retirement. It is about engineering. It is not preparing. You are not preparing. Saman nahi bandh rahe, aap pothi nahi bandh rahe. You are actually engineering and structuring a seamless transition. So when you look at it, let us look at age 55, that is around year 5, that is 5 years to retirement. It is a time where the foundation has to be put for the retirement planning. Detailed plan action should be there. When you look at year B, that is year 4, that is age 56, there has to be a risk mitigation, how you are managing the risk on your savings and the portfolio. So when you're looking at say year 3rd, we are looking at the portfolio transitions, and year 2, that is age of 58, there has to be income architecture to be put into place, and in year 1 there has to be the final execution and the trial run. So these are the steps that every year that you have to see. Now looking at blueprint, called as the phase 1, called as foundation as well as risk mitigation. So this is your year 5, this is your year 4. So in the year 5th, that is the first year, when you're planning, what should be the foundational assessment? Have to be comprehensive stock taking of what the exact position, hum kahan khade hain, and we have to identify the multi-year gaps. That means first, complete the net worth assessment. We should be knowing that unify all the assets and liabilities into a single portfolio view. Then secondly, we have to look at the health care gap analysis. We have to compare corporate cover as well as the post-retirement needs. Then we have to see third, ESOPs and RSU, restricted stock units. You have to map all vesting schedules and exercise windows. So have all your vesting schedules and exercise windows being completed. D, you have a retirement expense modeling. You have to project what are my essential expenses, what should be my discretionary, and what should be the legacy cost. So these things, these numbers have to be there in year 5, documented. Then comes the year 4. We are talking about protect against the key risks that could actually derail your retirement plans. That means you have to secure the individual health insurance, lock in insurability while corporate cover is still active. Secondly, add critical illness cover, convert your catastrophic health risk into manageable premium. So you have to have a critical illness along with that. And number 3rd, estate planning review. You have to update your wills and review all beneficiary designations. And point number D, strategize to clear all high interest debt before retirement. So you don't have to carry your debt or EMIs to your grave for that matter. Phase 2, which is called as portfolio and income transition. That is year 3 and year 2. When we look at the portfolio transition, you have to restructure the wealth building portfolio for the wealth distribution phase, because you need to get money out of your portfolio. There has to be wealth distribution. So what are the actions to be taken? First and foremost, you have to begin by equity de-risking. You have to systematically rebalance from the 70% equity towards to 35 to 40% equity. Because if you see in the last 1 year, the market returns have been around 10% or even less. For example, if you are near 60 years of age, so you will be saying, okay, I am having a 5 crore of the portfolio with 70% exposure to equity and the market is not doing well. So that will give you unnecessary of the psychic cost and the stress of money not being made. That too when you are nearing too much of the retirement. You don't have to wait to be 60 to take action. You have to be at 57 when you are actually planned for how much of the exposure to equities have to be there and to reduce the risk. So then we are looking at you have to build the income generating assets, and you have to increase allocation to dividend stocks, debt funds, rental properties, REITs, for that matter, it has now come into the equity category, much tax efficient. Now you have also to look into the ESOP exercise strategy. You need to begin exercising in tranches to spread the tax liability across multiple years. Like I have already told you, and there is a separate video on that, how the ESOPs have to be acted upon over the financial year so as to reduce the tax liability, because the impact is gonna be huge, which I will show you in a separate video and in a slide later on. So then we are looking at the real estate rationalization. You have to evaluate the consolidated properties to free up the capital. Now you might be having a 10 crore of the properties with zero rentals, or even fraction 30% of them, say for example only the 3 crore of the property might be giving you a rental which might be accounting to maybe 1 lakh of the income. So therefore that doesn't give any benefit to you. So therefore you need to optimize your real estate portfolio and put it to somewhere which will actually be generating money for you. You have to look into assets which are income generating for you. Now we are at the year 2 to go to retirement, which is called as the income architecture. Now here we are looking to design the specific income streams. We are into pre-retirement, but we are structuring our portfolio where we get regular dividends, we are getting rentals, we are getting annuity, consulting, we are also getting REITs, dividends through REITs or InvITs, or any assets for that matter, if it fits your risk appetite and all those things. Now the actions care, we have to design a systematic withdrawal plan, and you have to structure the tax efficient drawdown. You have to look at the modified 4% rule. So if you see my another video, the 4% rule has been based on US market with the lower inflation. In India, the inflation has been double, triple to that what had historically been in the US. So therefore 4% rule has to be modified to suit your expenses, and that too when the high net worth inflation is double or at least 4% higher than the normal retail inflation, lifestyle inflation for the others. So then there is an annuity evaluation. You have to assess partial annuitization or the guaranteed lifetime income. Then there is a senior citizen savings investments. You have to earmark funds for senior citizen savings scheme, Prime Minister Yojana and all those things. Then there is explore post-retirement activities. So you have to plan for whether you want to go for a consulting role or advisory roles for income or purpose, or you just have to enjoy your life. Now finally the blueprint comes in phase 3, which is called as the final execution and the validation. What does this mean? Now you have only 1 year to go. It is age 59 and it is the final execution. You have to ensure all systems are in place, validated and stress tested. Therefore you have to create a liquidity buffer. You have to establish 2 to 3 years of your living expenses in a highly liquid instrument. Secondly, you need to have a complete ESOP exercise. What does this mean? You have to finalize all equity compensation action before the employment ends. Thirdly, you have to create a master file of all accounts, credentials and contacts for your family. Then there comes the trial run. What does this mean? You need to spend 3 months living only on your projected retirement income, living only on the projected income. Now this is the ultimate stress test to validate the assumptions we have made and to reveal any hidden expenses that might still come up and might not have been accounted in the calculations, and you still might be having some salary and you have to make adjustments to it. Now we are looking at the strategic deep dive, that is called as the tax optimization. ESOP and RSU. For example, ESOPs have 2 tax events: prerequisite tax at exercise. So when you exercise your ESOP, it is taxed at salary level and also at capital gains. So when you talk at exercise, this is level 1 of taxation. Capital gains is at the sale of transaction. So for example, you have exercised it, ESOP, you are in 30% tax bracket, so obviously you are taxed on it. Sale, you are again taxed on it. So therefore, what needs to be done is a staggered exercise. You need to avoid pushing your income into a higher surcharge brackets. That means 25% surcharge above 2 crore. So you have to make sure it is under 2 crore, otherwise there will be a 25% surcharge. That means hold for 12 months, convert gains into slab rates up to 39% to LTCG 12.5%. Yes, you have to hold for 12 months. You need to convert the gains from the slab rate, which is up to 40% in terms of high net worth individuals, come down to LTCG of around 12.5%. Now we are looking at the capital gains harvesting. So when you look at capital gains harvesting, the opportunity is 1.25 lakh annual LTCG. Now normally it doesn't ring that much a bell. Okay, 1.2 lakhs ka annual gain hai, but how do it translate to the ultimate benefit as an investor you are getting it? Now it is a use it or lose it benefit. They are providing you 1.25 lakh benefit. Now that is your call whether you want to avail this or not avail this. Now what should be the technical strategy in it? Systematically sell and repurchase equities to book tax-free gains up to the limit each year. Okay, this we know. Now, what could be the 5-year impact? Now they can generate around 6.25 lakhs in tax-free gains while resetting the cost base. So not only your cost base is resetted, but 6.25 lakhs tax-free gains happen in 5 years. Now, for example, you are 2-member family for his husband and wife. So 6.25 means 12.5 lakh. So 2.5 lakh of the tax-free gains can be done over a period of 5 years for that matter. Your cost base is also resetted. So cost base can be huge. Because if you are getting 1.25 lakh a year and assuming that it has been average 10% of the return, so 1.2 lakh means there had been a corpus of around 11 lakhs for 10 lakhs for that matter. And in 10 years, 50 lakhs, 51 of the corpus has got a resetted to a higher base. So on the higher base of 1 crore of the corpus over 5 years, again there is an exemptions going on, so that the multiplier effect could be the huge. So then there has to be a withdrawal sequencing. So when you're looking at EPF, PPF, NPS, 60% lump sum or 80% lump sum, because NPS many changes are currently undergoing, and gratuity up to 25 lakhs. Now the tax on them are exempt. So when you're looking at annuity from NPS, it is taxable as an income. So you have to see what you need to withdraw. So that which is taxable can be deferred. You can at least for your expenses start withdrawing the money. Another strategic deep dive is how to secure your health and legacy. For bridging the corporate healthcare gap, the reality is a typical CXO policy, that is 1 to 2 crore of the health cover, is nearly impossible to replicate post retirement. That is for sure. Now an individual cover, when we're talking about at the age of 60, can cost you around 2 to 4 lakhs annually if it is applicable. So now you need to be looking at a 3-layer solution. What does first? There has to be base coverage. So you are securing a 1 crore health policy at the age of 55 and 56. That is the year you need to take it. Second is you need to maintain 25 to 50 lakh liquid funds for uncovered expenses which might not be covered in that policy, or if your policy is not, say, having a global coverage and something happens and you have to be treated abroad or something. Thirdly, if that case be, or within India also, if there is something comes up which is not covered, so that can be taken care of. The third level is the super top up. Add 1 crore of the super top up for any of the catastrophic events that may come. Now, this is a part of the corporate healthcare gap. When we talk about the legacy, it is imperative that Runway is the optimal time to align the retirement and estate plan. So what your actionable should be: will review, update and reflect your current intentions and assets. Second, beneficiary audit. That means check all nominations on all accounts, whether it's insurance, mutual fund, demat. Outdated nomination can cause actually costly complications. Power of attorney: execute durable power of attorney for the finance and healthcare. Consider trust for substantial estates or complex family situations. You need to consider trust. We are talking about returning NRI executives and how they can transition, because when you're senior executive, you could be overseas, but now you're planning to come down to India and resettle back. So return to India requires complex coordination across multiple jurisdictions, ideally beginning 3 to 5 years before the move. So if you are planning to come back to India, there are still 3 to 5 years to it. That is the time when you should be actually planning. What could be the planning areas? Take residency status. Now you have to strategically plan the transition to the resident but not ordinary resident RNOR status to shield foreign income from Indian tax up to 2 years. So you can save that from taxation for the 2 years if you have structured well. Second is asset repatriation. Structure the timing of bringing the overseas assets to India. Example, NRI balances remains freely repatriable. Last, manage withdrawals from 401ks when you're talking about US or IRAs, considering the tax treaties DTAA to avoid double taxation. So now we are talking about here spotlight for US based NRIs. Now when you talk about PFIC, passive fund investment companies, you are talking about Indian mutual funds. They are considered PFIC by IRS, requiring complex reporting and punitive taxations and penalties. Now this must be addressed before you return. Secondly, ongoing reporting. Now US persons must continue FBAR and FATCA reporting on all Indian accounts. That has to be continued doing. Exit tax. Now green card holders may face expatriation tax on unrealized gains. So this has to be taken into consideration. Beyond financial architecture. Now this is what a boutique wealth firm brings to you. When we are your consulting partner, we are working on planning your post-retirement identity also. So for executives whose identities are intertwined with professional achievement, the retirement is not just a financial. So you are talking about retirement is not just a financial transition. It is an existential one, twined with your own existence. So therefore, the most successful retirements are those where purpose are deliberately cultivated. So we sit with our clients to discuss with their aspirations, what they want to do, and then try to recreate, rebuild, and find the purpose in their life and help them cultivate that. So what we look into it is leverage their expertise. So begin positioning for the non-executive board roles, advisory positions, or part-time consulting. Share wisdom, explore opportunities for mentoring the younger professionals or teaching at business schools. Structured philanthropy. So that means move from ad hoc donations to a strategic charitable giving plan that reflects your values. Lastly, build lifestyle foundations. That means use the final years to establish the health, routines, social connections, and hobbies that will sustain you. You work when your work structure disappears. So therefore, when you're talking about the retirement runway from career achievement to generational security, the core argument is the 5 years preceding retirement are a unique window where the peak earnings and the accumulated wisdom create an exceptional opportunity. Approaching this period with a strategic rigor consistently preserves wealth, enhances tax efficiency, and ensures seamless transitions